Okay, so unconventional monetary policy, which is now a bit funny because when it was announced in late 2007 and widely adopted until the mid-2010s, we could say that, okay, these are unconventional measurements. So practically which means that once central banks in different places were facing with deflationary pressure, they cut down their interest rates to stimulate aggregated demand. But the problem was that it was absolutely not enough. So sooner or later, many of them had to adopt a mix of new instruments, and everybody was thinking that, oh, this is just a temporary thing until the crisis is over. And obviously, as happens in many temporary things, then all these instruments are still with us today. So that's why this unconventional thing became much more conventional. Just we have to still separate it from the old-fashioned and well-defined, absolutely well-defined set of instruments like Taylor rule and all the other things that we learned last week. So these unconventional tools are used for crisis management, and this is absolutely asymmetric, so we can use it only in the case of a significant decline in the aggregated demand. So somehow there is a sudden stop in funding liquidity, so it's really hard to get any loan, or it's really hard to issue any bonds to collect funds. So that's why not just the interest rates will be reduced, but also since most of the long maturity lending is not functioning at all, so the transmission channel is completely dead. So even if you are doing something with the short run interest rate, it has now not much transition on the long run interest rates in bank lending or in bond markets. So that's why the central bank should go back to the whole yield curve and to manage it, even if the big lesson of the 70s was that if you are doing it, maybe you can create an inflation. The worst case scenario is a stagflation, so you have economic stagnation and also inflation at the same time. So that's why central banks try to avoid this. But also they had a decade when it was not a big deal because inflation was close to zero and absolutely below the targeted 2%. So sometimes it was reaching 2% and fall back. So practically the whole 2010s were not a stagnating economy compared to the current stagnation, but it was close to stagnation. But at least GDP was growing in some of them, even if they had to do such desperate measures. So non-standard measures can be initiated by the interest rate is zero. This is called zero lower bound. So what happens if we should still stimulate the economy according to Taylor rule and other models, but now we would go to negative territory, so we should do something else. Obviously, some central banks even define negative interest rates, but we have to be really careful with that one because it's really bad for savings for the household, so it can create capital flights and other things. So this is only to discourage the inflow of external capital to avoid appreciation in small, really small economies like the Danish or the Swiss economies. Yeah, so what can we do? First of all, we have to calm the market, so that's why this forward guidance became the other buzzword for this time period. So we have to highlight that we will doing this aggressive purchases until inflation will be stabilized around the target level. So right now we are going towards the targeted level of inflation from above. So from negative territories or close to zero territories towards the 2%. The second big question is that are these non-standard measurements for everybody, for all central banks, or these are only for key central banks like the ECB, US Fed, Bank of Japan, and so on, but these are not for small and open economies. So this is what we are studying with Mercedes Mészáros since the mid-2010s. Because what we can see here that once there was at least a list of different unconventional or non-standard instruments, small central banks in small and open economies try to adopt them, but what we can see here that currency depreciation was mostly the end product. So you can do it, but these are not for the small economies. Okay, and then what we can do here. So at the beginning, IMF, Bank of International Settlements, and also key central banks issued many reports about this topic, but and you can see some citations also, but what we can see here that there was, and still there is no coherent description. How can we do this? So there are no rules that, oh, if we are changing this variable here, then this will happen automatically. So even if Taylor rule had some kind of automatism built in inside of it, in this case we don't have anything like this. So also they created the distinction between quantitative and qualitative easing. At the end of the day, nobody uses this. Everybody says QE, so some kind of a combination of quantitative and qualitative easing. So in the case of quantitative easing, it means that the central bank still purchases high quality assets or still provides loans, longer term loans with collateral which is high quality. What means here that, okay, everybody is afraid of deflation. What happens and what happened between the two world wars during the Great Depression or Great Financial Crisis? Everybody started to, or the remaining investors who did not lose all their savings, they started to go into safe assets. So let's purchase gold, let's hoard cash, liquid cash, because we can change it to gold. So things like this. In the modern environment, so in 2007 and 8, government bonds. So AAA rated, AA rated government bonds were the target. So in this case, we can say that the central bank starts to buy up also the same asset. So practically you are pushing out the investors from the safe assets because you are faster than by them, and you are eating faster, and practically they have no cake at the end of the day because you are purchasing everything what is on the market, or at least a significant part what is already on the market. And in this case, we can say that, okay, we can cut or reduce the interest rates in the government bonds. So, which means that still the central bank will keep high quality assets in their balance sheet. So on the asset side, still, we can say that, okay, we purchase a lot of government bonds, but still these government bonds are domestic, they are still AAA rated, AA rated, so they are good enough. And also at the same time, we issued a lot of money, so that's the problem, but we did this because we wanted to create liquidity, because there was a liquidity scarcity. So hopefully if we calibrated this well, then this excess liquidity will not transform into inflation immediately. But it will be transformed towards lending, and then it will be absorbed by the economy. And we are hoping that if we are doing this, then also private interest rates will start to follow this. It was not working at all. So, quantitative easing became much more popular during the 2010s, then they realized that also central banks should and must mingle with private loans and private debt as well. So this is when central banks are starting to purchase commercial paper, so corporate short-term bonds, corporate long-term bonds, sometimes even exchange-traded funds, sometimes even real estate investment trust papers like it happened in Japan. So qualitative easing, it's a strange combination of providing liquidity, but also somewhat consolidating the economy. So purchasing a lot of bonds without the intention of selling it in the future. So we just keep it and buying it up. So some people says that practically this is market making. So in the past, central banks had always this job since the beginning, so since we have central banks, they had always this job to be the lender of last resort. So if a commercial bank needs liquidity, then at least in the domestic currency, they can turn towards the central bank and they will get the loan. Similar thing will happen under market maker of last resort functions, because in this role, the central bank will step in all the different bond markets. It can be public, it can be private bond markets. And in this case, it doesn't matter that how much are they purchasing, but they will calm down the investors that even if you would like to exit, then there will be a stable player who will buy these bonds from you. So some of this instrument will be just calming, it will be just doing nothing at all, just be there as a central bank. But again, how can we fine-tune this? We have no idea. So they try to learn this on the run, and we still have no idea. So after 1.5 decades later, I can say that if we are opening this book, then this book will completely describe what to do with these instruments. Nothing at all. So what we can see that in quantitative easing, we are extending the balance sheet. In qualitative easing, we can sell some of our high quality assets and purchase lower quality assets, so corporate bonds from this one. Usually they are combined, so we have always qualitative and quantitative easing, so they are increasing the size of the balance sheet, bubbling, tripling, varies, and also they are starting to purchase also lower quality assets. Yeah. So what are the instruments? So I mentioned some of them, but we have a nice slide for this one. So first of all, in case of lending, they are extending the usual 2-week maturity to half a year or sometimes even 1 to 3 years. So again, they are extending into the yield curve. Also, they are increasing the set of the acceptable collaterals. So not just government bonds, but also commercial paper. So short-term corporate bonds are accepted. Asset-backed securities are accepted. That was absolutely a no-go territory during the 2000s. So that was also novelty. Also covered bonds, like mortgages, things like this can be accepted. In case of security market, these are really simple. They are purchasing. So they are purchasing government bonds, they are purchasing also commercial paper, so corporate short-term bonds, and even sometimes asset-backed securities as well. So we will see it later on. And also, what was a new thing, that they start to lend in foreign exchange rates. So, because central banks are usually providing loans in their own currency, so that's why they are central bank. But it happened already in December 2007, so way before the collapse of Lehman Brothers, in the next year, September, that central banks started to provide, at the beginning, just loans, short-term loans in US dollar. Overnight, 1 to 2 weeks, for 1 month it was only in Switzerland, but we can see that there were issues that in the past, and even today, that if you need, so like as a French bank or Japanese bank, if you need US dollar liquidity, then you are just go to a US money market fund, you are taking up this short-term overnight or 2-week loan, and after that you are giving it to your client if they need loan in US dollar denomination. It was absolutely an automatic thing that if you need it, then you were able to go to the US. Unfortunately, since then, there is a scarcity in US dollar liquidity, global scarcity, which is really funny because we are always saying that, oh, there are a lot of US dollars on the market, we could buy the whole planet from US dollars, so there is an excessive US dollar emission, but it is not. So again, if you are checking the data, unfortunately, they were thinking that, oh, this will be just a temporary measurement, so they were creating just half-year contract, and they were creating this and renewing these half-year contracts for many years, until 2013, when they were just creating a standing agreement, and until today, we have this. Sometimes they are cancelling it, sometimes they are extending it, they are installing it, but it doesn't matter, we have always them. So sometimes just US dollar liquidity is allocated, sometimes also Euro, British pounds, Swiss franc. It depends on the actual situation. But at the end of the day, some central banks were just creating a secondary yield curve for themselves to manage, in this case only on short run, but in a foreign currency, which is absolutely crazy. So later on I will talk about this. So if we are checking the application of unconventional instruments among different European central banks, so the Hungarian, the Polish, the Czech, the Swiss, the Danish and the Swedish, and this is the ECB, we can see that practically they were doing all the different possibilities. So that was the job of Mercedes. She collected it. Also, I started it, but after that she continued the database. So we can see that during the golden age of unconventional instruments, everybody tried everything. But in case of Japan, this is where they were trying to design all of these things. So unfortunately, Japan is in a really long-term stagnation, economic stagnation since the mid-90s. So when I was a student, people were talking about the lost decade of Japan because it was already 1 decade long stagnation. Unfortunately, this stagnation still continued. We can see that during the last 2 years, suddenly they started to have inflation and also some positive GDP growth. But the problem is that if we are just checking the slides, we can see that they were implementing or developing the list of instruments that we were talking about. And once it was successful for 1 or 2 years, then the next global crisis arrived, and after that they had to start again from scratch. So this is a key problem, that once you are able to stimulate the economy, then you are going down because there is an external or exogenous shock. So we can see that they were playing with reserve targeting, they were playing with, they tried to cut down risk premiums of financial assets, so they were buying things. Also, they tried to communicate much more. But we can see that they were able to achieve something, so they were able to increase their interest rate finally in 2006 from 0 to 0.25 and then to 0.5 until October of 2008. So that was the time when finally they were able to see that, okay, now these things are working, and until they didn't. So what happened in their case, the monetary base was constantly increasing. So at the beginning, the monetary base was 9% of the GDP, and then it was rising only until 2006 to 22% of the GDP. So they were way ahead of the other central banks if we are just checking what happened with the set of instruments. So at that time, everybody was just looking at, okay, what kind of weird thing is happening in Japan. 10 years later, everybody realized that, oh, we are doing the same thing. Okay, so again, they had to do something with the next crisis. So they had this comprehensive monetary easing between 2010 and 2013. Again, they did many things. So obviously cut down the interest rates because it's simple. But also they started to purchase assets. And after that, these things were implemented as well. So government bonds, long-term. So we can see that now, maturity of 3 years. Also short-term government bonds, corporate papers, so corporate bonds, long-term, short-term, exchange-traded funds. Also, they try to enter into real estate development business because they are also bonds. So they try to do many things. And after that, they realized that it was still not enough because after that the big earthquake arrived to Japan and also the Thailand floods happened. And also the European sovereign crisis happened also at the same time. So they had 3 different exogenous shocks. So they implemented the quantitative and qualitative monetary easing in 2013, 1 year before the European Central Bank had their own program. So we can say that they were saying that, okay, let's double the monetary base. What can possibly go wrong? It had not much effect, at least they were able to avoid the deflation further. So they had some kind of a positive inflation, but that was all. So we can see that it was absolutely an aggressive program. So mostly they were purchasing government bonds. Now with the 7 years of average maturity, also they stepped in the corporate bond market. And so in this case, what we can say that, does it matter that how much public debt you have if your central bank, even if on the secondary markets, obviously they are not buying government bonds directly from the government, but still from the secondary market you are pushing out all the investors. Because the problem was that Japanese companies started to purchase government bonds. So instead of doing investments in the economy to create jobs and services and products, they were so afraid of the economic stagflation or stagnation that they were just buying government bonds because these are stable. So that's why they had to be also pushed out from this. So at least stock prices started to increase. Also, they had this exponential expansionary fiscal measures in this time period. And unemployment rate dropped under 4%. If in Europe we have 4% of unemployment, we are saying that now we have scarcity of labor force. In Japan, they are calling it as a recession. So it's always strange. And also, deflation was at least disappearing, so we can see some kind of inflation, so 1.3%. But we can see that this is absolutely brute force. So if you have to do, and not just do, but maintaining this. So this is not just for 1 year, but they continue this until 2022 to maintain such behavior in the economy. Then we can say that, yeah, you are in deep trouble. Okay, so in the case of the ECB, we will see similar features. So these are all the loans that were provided by the ECB. These are all the securities that they purchased. And also these are the international reserves, so gold and foreign exchange reserves all together. And they are the other instrument. So we can see that ECB was absolutely boring until 2007. So they had a really small balance sheet. So this is the Euro system. So all ECB and all the underlying central banks within the Eurozone. So they are consolidated balance sheet. What we can see here, so all their assets were just, yeah, doing some job, but who cares? And after that, okay, they started to provide loans because, oh my God, there is the crisis. But they were thinking that, oh, it was a short-term thing. Then that crisis arrived, so that was the sovereign crisis in 2010, so they had to react on it. So we can see that lending was increasing, but it was taking several years until they realized that practically this is a bond market related issue, since the whole sovereign crisis was happening on the bond market. So after several years later, the ECB realized that maybe we should go into the bond market. So after that, they started to purchase bonds. So we can't say that they were doubling the amount of bonds in their hands. They were doubling, tripling, 4 times, 5 times, 6 times, 7 times, 8 times higher. But we can see here until inflation happened, and we know that this inflation was also, some of it was internal, so it was endogenous, because obviously if you are doing this, then it should have a limit. So already in 2009, we were able to see that inflation started to reappear. So there were rumors that, okay, they will slow down this expansion. Just then COVID happened, and again, everything was moving towards deflation. So they have to continue it, but once all the inflationary shocks were happening in 2022, then they announced that, okay, they are discontinuing. So still they have a lot of bonds without a clear exit strategy. So this is the key problem here. So we can see that, yeah, lending disappeared practically completely, but the bond portfolio only disappears when it expires. So until then, you just have to keep it. So we can see that all the steps, but you don't have to learn it. Just I was collecting it for many years now, so we can see the end product of this collection. So we can see that here at the beginning, in 2008, in Europe, everybody was thinking that, oh, this is a US problem, who cares? Then, okay, there were 2 banks which had to be bailed out, but oh, this is just a minor issue. Then suddenly Ireland was really close to default because their banking system was absolutely affected by the US problems, because they purchased a lot of toxic US government or securitized loan. And after that, it started to eat itself into the economy. Once complete lending and sometimes even complete bond markets ceased to exist because demand disappeared once the Lehman shock happened. So, okay, what happened there? That they started to cut interest rates. And well, many things are happening here, but okay, so let's see. The ECB was still focusing on this enhanced credit support. So, yeah, we should provide longer term loans, not just for 2 weeks, but maybe for 1 year maturity. So not much. Also, they started to accept collateral, like asset-backed securities, but it had to be BBB rated. So we can see that this is absolutely a conservative approach because these are still investment-grade assets. Also, they purchased some convert bonds, so we can say that, okay, they started to purchase things, but it looked like this. So they had a lot of loans suddenly, but in case of securities, they didn't have much. Not changing at all. Securities started to accumulate later on. Also, gold was only increasing because gold prices were increasing. So the quantities completely the same. They were not purchasing. Yeah. So if you are comparing central bank balance sheet size to the GDP, we can see that already within a year everybody was increasing, and people were thinking, oh, this is just temporary, until it isn't. Yeah, this is when they realized in 2010, so 2 years later, that, oh, we should purchase also government bonds. So let's go into the secondary market and buy from private investors. And also they started to purchase private debt, practically both on the primary and secondary market. So even in case of issuance, they started to go in and buy. It was not enough, so they had to expand the asset purchase program, and the asset purchase program is still with us today. So right now it's discontinued, but they had to manage the portfolio. And so they created an asset-backed security purchase program, they created covered bond purchase program, and they were thinking that maybe in the future, if there will be any kind of a loss, then what will happen that practically they will just use up the capital of the ECB and also the capital of the national central banks. And if it's not enough, then still they can use taxpayers' money. Luckily, this was not the case. So in this case, they were afraid that what happens if there will be a widespread default on the bond market. Instead of widespread default, there was an inflationary spike, which meant that interest rates were increasing, which means bond prices were decreasing. So the value of their bond portfolio was shrinking. But if you are keeping bonds until they're expiring, then you have no losses, just in accounting terms. You have to reevaluate your portfolio, but if you are not selling them, then it's not a real issue. So they were thinking that, oh, we are just purchasing things until 2016, September, so it's nothing serious. And they were just defining. That's why I added it here, because we are always referring them as asset-backed securities, but you can see here that there were mortgages, there were loans to SMEs, there were real estate mortgages, auto, car loans, leasing, consumer finance also. They were purchasing a huge variety of ABSs. Unfortunately, we have not much public data about this portfolio. So we can see that how much money was allocated, but we have no idea into what and what is the composition of these things, which is sad. And again, if at least the bond is singularly rated, then the haircut is 10%, so it means that market value minus 10% will be the purchasing price, which means that only the most desperate sellers will go only to the ECB to sell their bonds to them. So still they were trying to maintain that, okay, we are market maker of the last resort. So last resort means 10% from the price, or 22 if you have doesn't have this singular rating. So they were still trying to maintain some kind of strictness. Also, they provide the short-term debt instruments, so they were providing debt into this, and also they were accepting assets denominated in pound sterling, yen, or US dollars as eligible collateral behind lending, which is also not that common. So okay, we can say that they had some markdown again to mitigate some of the price change risk, but it's not that usual that we can see something like this. And also they had to deal with Greece and Cyprus because they were subject of, we can say bailout, but subject of procedures to stabilize their public debt. So we can say that they were absolutely aggressive in case of haircuts for Greek government bonds in many cases. Okay, private players can sell them just at nearly 60% of haircut. Yeah, in this case it doesn't matter. After that, they started to extend these procedures. So secondary market public sector asset program. We have 1, 2, 3, 4 of them. What matters that once they started to purchase them, then they started to purchase a lot of government bonds. So it was really popular. And also, if you would like to see what happened not in the market, but on the continent, then we can see that mostly, so there is a huge variety of different programs. So the problem is that they were creating programs for everything, so that's why we have no idea what is happening in comprehensive level. So our approach is to say that, okay, what is the composition of the balance sheet? Because at the end of the day, if we are comparing all the loans provided to the banking system and all the securities which were accumulated in their balance sheet and comparing them to the foreign exchange reserve, then we can see some ratio which defines the stimulus. And in this case, we can see that, yeah, it was growing for the ECB. But in many other central banks, they did nothing at all. So they remain still absolutely driven by foreign exchange or international reserves. So we can see that what is Danish central bank was absolutely not doing anything. Okay, they were quite aggressive at the beginning, so in 2008, but after that, just provide only short-term liquidity loans as they're supposed to the banking system and nothing more serious. Only this one, yeah, this is the Hungarian central bank, but this is in this scale, so we can see it's 0.2%, not 5% what is happening in there. Sorry, 5%, 5 times bigger. Yeah. But also we can say that that was highly necessary because risk premiums against German long-term government bonds were increasing a lot. So this is for Greece, but even for real countries like Portugal or Ireland or Cyprus or Spain, we can say that they had to do something with this one. So obviously when they started to purchase a lot of government bonds, then bond prices were increasing, yields were decreased down under 5%, so we can see that this is really small and even it was decreasing further and further. So, and also at the same time, fiscal stabilization happened, so the European Financial Stability Facility was initiated in 2010, and after that the European Stability Mechanism was created 3 years later, and we will learn about them during April or May, so soon. Okay, so at the end of the day, if we are collecting all this rat's nest, what was set of different programs, right now the ECB says that they have, or they had these 4 programs, so they forgot about all the rest of them. So they had the corporate sector purchase program, so they were purchasing corporate bonds, and in this case they tried to create some kind of a green-ish monetary policy, because these are the only tools. So they have the bond portfolio and they are trying to purchase bonds from different green sectors, or at least projects which were financed by bond issuance, and these projects are focusing on green projects, but on if you are taking the course of green finance, so we have a specific green finance course during the next semester, you can learn about this, because if we talk about green bonds emission and all the other greenery in finance. So yeah, this is just one element. And also they have this public sector purchase program, so when they were purchasing government bonds. And in this case, it's really funny because so what will be the breakdown of the different government bonds? So how can you decide that, okay, 30% of my portfolio will be German government bonds? So how can we say that this is 20% or 40%? And the thumb rule was that they will weight the different countries by their weight in the equity side of the ECB. So whatever shareholder package you have in the ECB as a country, then this will be determine your share in the public purchase program portfolio, which is a bit funny, but they had to decide it somehow. So we can see that, okay, this happened. Also, they had back security purchase program, not much information, unfortunately, about this one. And also they had a covered bond purchase program, the third one, but also there are not much detail about this. So if you are checking the last known data, so I downloaded today from the ECB's website, we can see that Germany has 23% of share in case of the bond portfolio. Also, Spain has 12%. This is supposed to be, yeah, this is Italy, so 20%. Also, we can see France with 15%, and also we see other countries. And also there are supranationals, so IMF, ESM, and everybody else who are can be considered as supranational issuer defined here. Yeah, so which is really strange, because if we are checking different countries' share from the overall public debt, we will find different numbers. Not in case of Italy, because Italy is around 20%, but for example, German share is way lower than the Italian one. So we can see that this is of compared to the actual size of the debt market and breakdown of the government bond debt market. But also we can see that many of these bond markets are absolutely closed. So mostly it's financed from domestic savings, from domestic banks, from domestic investment funds, from domestic insurance companies or pension fund investments. So it would be really hard to define proper weights. Also, what we can see here that nowadays they are just not purchasing anything. So they had purchases in the 2010s, then during COVID, and then nowadays they are just letting it run out. At the beginning, so in the at this time period, they were still, if something was expiring, then they were purchasing the same or something similar. So some kind of a government bond, some corporate bond, whatever, but they were buying the same asset class. Nowadays, they are not doing it, so if something is expiring from the portfolio, then they are just collecting the cash and they don't care anymore. So at least they are not selling it. So the most aggressive solution would be that to remove excess liquidity from the market if inflation would be way higher. In the worst case scenario, they could forcefully sell their bonds back to the private market, and in this case you can extract as much liquidity as you want, because at the end of the day they are sitting such a huge pile of money. So right now altogether, if you are adding them up, it's 2.8 trillion euros. We can buy a lot of concrete from that one if we would like to build a road or something from this, but obviously you cannot spend it as a central bank, because it would ruin the whole economy. So that's why I mentioned that partially some of this money is a bailout or a consolidation. Even if the set of this portfolio still can be considered as high quality in terms of credit rating. But, so if you are checking the statistics right now, I worked so hard on this on Friday. I even added the recession time periods according to the ECB. So we can see that if recession happens, then they become much more active. Not much because this recession started in 2010 and they became really active only a year later. But okay, ECB is always behind the facts. So we can see that at least they jump much more or much faster. We can see that also at the beginning, so this recession started already in 2019 when they were afraid of higher inflation. So that's why we can say that they were not reacting to anything. And then when the inflation happened due to COVID, then okay, let's continue things. Let's buy more. So, okay, there is a typo, but so the reaction on the COVID pandemic was that let's create another purchase program because it's so good to have new phrases. So they were just buying more stuff. So commercial papers, government bonds. But after that, it was discontinued. So it was a temporary thing because it was just operating for 2 years at most. So we can see much more like a spike in terms of purchases. Also, they provided 3-year long loans with discounted level of interest rates. Also, they created a new way of lending for 1 year. But also we can see that, yeah, they were creating this, but since they were shorter because 3-year and 1 year maturity, but still they will disappear really fast from the balance sheet because they are not that long maturity compared to the 30 years in case of government bonds when they were able to or allowed to purchase. So, okay, key refinancing rate was at that time 0%, so you cannot go under this one. Also, they lowered haircuts at the bond-related instruments. So they were less strict about regulatory capital. To be honest, I read the paper, I read the report, and I have no idea how they did this stuff. Because when I was a student, we had only one regulatory capital, that was the 8% in Basel II. In Basel III, it was still 8%, but nowadays they made it so complicated with the different tiers and layers and everything that I should learn the completely new thing up from scratch. So it will be a completely different class to learn that. Yeah, so we can see that if we are checking the status nowadays, then we can see that all of them are discontinued. They are still keeping the portfolio, but now they are just letting it to run out everything. So, as a conclusion, that there is no clear exit strategy from quantitative easing. So it was a temporary measurement, but we had no idea how to calibrate this. So, with my studies with Mercedes during the last 8 years, 10 years now, we were able to see that if we are looking on the balance sheet structure, we can have different, similar calibrations like in Taylor rules. So we can say that, okay, balance sheet structure reacts similarly on business cycles, it reacts similarly on many other things in the economy. So we can say, but still there is no comprehensive and coherent structure which would define what is this exactly. So we have no idea how to purchase new assets, how to define the set of the new assets, what to do with the expired principal, reinvest it, not to reinvest it, when to not to reinvest it. Also, how to integrate it into inflation targeting monetary policy. So we are just playing with things. And okay, we know that we are market maker of last resort, just we have no idea which market to be on. And we can say that central banks can be stable buyers, but they can also choose that we are not doing anything. So sometimes they are withdrawing from some bond markets, then sometimes they are re-entering it. It depends on the actual crisis and nature of the crisis. So, yeah. Okay, financial stability. The story is really simple. In the 2000s and during the 90s, everybody was saying that financial supervision should be completely separated from the central bank. So, if you are doing it as a central bank, then you will be warned by the IMF and so on. So the Czech National Bank, when they were creating, so after the separation of Czechoslovakia in 1992, after that, the Bank Supervision Authority was always part of the central bank, and even one of the vice presidents is always responsible for banking supervision. Even, okay, they had a real estate bubble in the early 2000s, but they were managing it. So they have a really strictly managed banking system compared to the rest of Europe. And what happened that when I was checking the press releases since 2006, they were always warned by the IMF that please don't do this because it's not good for inflation targeting. And obviously what happened after 2008, people realized that, okay, financial supervision authorities were always focusing on prudence in lending, but meant that microprudence. So if loan is provided by the commercial bank, does this meet the requirements of the law? So are you doing things legal or not? So, then they realized that, okay, but if you are just focusing on this one, then nobody looks on the big picture. So is the banking system overall healthy? If they are providing liquidity, maybe they are just funding everything from external short-term currency denominated, foreign currency denominated loans. And whenever external shock will happen, then the whole banking system will be died and they are not able to provide loan anymore. So that was the lesson, or one of the key lessons of the 2008 crisis. So suddenly all the central banks in Europe, especially the ECB, started to reintegrate banking supervision. So nobody was blaming the Czech National Bank not to do this anymore because now that was the new fancy trendy thing. So especially the single supervisory mechanism was created. So now the ECB supervises the most significant banks. So we have 3,000 something banks, but mostly 2,000 banks in the European continent, within the Eurozone, within the EU. So, okay, there are really small banks, but they are not doing business with the ECB. So 2,000 are relevant. And after that, they were just picking out 120 something by focusing on different factors. So cross-border lending, size of the balance sheet, so things like this. And after that, they are supervised by the ECB, because in this case, they cannot play out different member states' financial supervision authorities by moving bad assets around. Because this happened in many cases. Okay, sometimes they were also laundering money, because this is also the purpose of the financial system. But not just money laundering happened, they tried to mess up many non-performing assets in their balance sheet. So now it's harder for them to do that. Because the ECB sees everything, not just within the Eurozone, but also within the EU. So that's why it's way harder to do nasty things. Yeah. So we can see that nowadays macroprudential policy is supervised by the central banks, and to manage liquidity crisis, excessive concentration of loan or anything. So it should be atomized in the financial system. Misaligned incentives towards management, towards sales, and also to prevent excessive credit growth, because politicians will be really happy until the GDP grows because of excessive lending. Just that sooner or later we have default because of this, or multiple defaults. Yeah. Okay, so I don't want to care about bank loans, credit rationing, and so on. What matters? Okay, so this number is always changing, so sometimes it's increasing, decreasing, that how many banks are significant. But what we can see here, that practically they were defining just the value of assets, so the size of the balance sheet, and also cross-border lending. They should be high enough to be significant for the ECB. And after that we can see some breakdown, but this is only just for illustration to see that